U.S. stock markets still hungover from Thanksgiving, or what is going on with them just choosing to artfully ignore what's going on everywhere else in the financial markets? That's the question that we're going to ask ourselves here. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And our main question today will concern how it is that yields are falling, the dollar is lower, more and more interest rate cuts are making their way into the Fed policy outlook, and the stock market is apparently asleep. If you were to say all of those things and asked, well, what's the S&P 500 doing if yields are falling and the dollar is weaker and more rate cuts are expected? Well, the answer really since the middle of 2021 would be stocks are soaring. If you looked at what that meant for this past month of November, the answer would be exactly the same. And yet now, things seem to be idling. So we're going to have a look here at what we could see in the coming days to maybe wake this market up a bit, or indeed why it is asleep in the first place. So we'll start with how things have been going so far in November, why they've been doing what they've been doing, and then see if we can get a little bit of a catalyst as economic data finally starts to pepper the calendar here. The PCE inflation measure will be our focus today. It's the Fed's favorite inflation gauge. We'll see if when that comes across the wires in less than 24 hours here, this sort of lull for equities can be shaken loose. So let's start first with a bit of stage setting. Here's how things have been going basically since the beginning of November. You can see that the S&P 500 bottomed in late October, just before the turn of the month. That coincided with a topping in the OFR Financial Stress Index. That's from the Office of Financial Research, which is an arm of the U.S. Treasury Department. And so you see that everything here appears to look like smooth sailing. So markets are getting less fearful, equities are going higher, and indeed, we are on pace for one of the best months in years for U.S. equities. So the general mood here in November, seemingly very, very positive. What's going on? Well, it's certainly not the two wars that are ongoing at the moment, one in Ukraine and one between Israel and Hamas lighting up the Middle East. It's certainly not corporate chaos at OpenAI recently, which is easily the biggest darling of the artificial intelligence space, which itself is easily the biggest uplift and the biggest source of strength in the tech sector, which is itself easily the biggest contributor to equity gains this year. So all of those things are obviously not perturbing investors here. Not the wars, not the chaos in a critical sector of the market. All of that seems to be generally okay. How is that? Well, as ever, the story comes back to the Fed and the cost of money. Because as we've made the case countless times here on Overtime and on Macro Money and on other shows where we cover the macro, and as we probably will continue to do, the cost of money is the overlay to all things before we get into asset allocation of any kind, before we get into investing of any kind, or for that matter, before we get to spending money on anything at all, be it investment or consumption or whatever it is. The decision whether to spend money or not spend it ultimately comes down to how much that money costs to spend. And that, of course, is the cost of borrowing it back if it's lost. And so it is the decline in interest rates and therefore Fed policy expectations that are behind that decline that look to be easily the most impactful catalyst for what is going on, wars and corporate scandals notwithstanding. This is what's been going on really since the start of the fourth quarter. So we went into the September FOMC, you can see it on the screen here, with a sense of what the Fed policy expectations looked like, of what their inflation expectations looked like. So we had a baseline going in. And at that September 20th meeting, the Fed said, right, here's your updated baseline, and gave a new summary of economic projections for the first time since June, where they said, we think that we're going to need for interest rates to be 50 basis points higher in 2024 than we thought earlier. And really cemented what we now constantly toss around as this higher for longer perspective on policy, where there's not necessarily more rate hikes, but rates will remain higher and cuts will be delayed. And you see the markets respond here very clearly. In the yellow is the New York Fed's measure of the term premium in benchmark 10-year U.S. government bonds. And what this is essentially the cost of uncertainty. So if you are concerned about lending over a longer period of time, that is a longer term, because you think that more can go wrong over that time and things are inherently unstable or unclear, you're going to demand a higher rate of return in order to do that. And so what you see from that meeting in September is surging term premium, that's the yellow bars there, and with it, a sharp rise at the longer end of the yield curve. So you can see the 10-year yield here goes sharply higher, even as the 2-year yield basically idles, that's the line in the green, because no more rate hikes are expected. And that front end of the curve at the 2-year line is the most sensitive to immediate Fed policy expectations. So you can clearly see that the markets say, okay, well, we don't know what higher for longer means. We have a good sense that higher means no higher than we already are at that point, but we don't know what longer means. And so that means more uncertainty. And so the term premium goes up. And with it, longer end bond yields go up. Fast forward to the November 1st Fed meeting, the latest one that we've had now. And the Fed comes out and says, right, so it looks like the increase in interest rates that came because of this upswell in term premium, it looks like that's already done the heavy lifting for us. It looks like the extra 50 basis points in higher rates that we thought we needed, that's been done by the bond market. It's there. And so the markets conclude, well, then you won't have to hike anymore. And indeed, cuts are coming into view. And so what you see subsequently is, of course, the 10-year yield falls back. Uncertainty falls back. So the yellow bars slump back in the direction of zero. So term premium deflates. And the green line starts to actually push lower. And that's pointing to expectations for rate cuts. You can see that in spades when you look at the shift in the implied policy curve as reflected in Fed funds futures, which are interest rate futures that follow the Fed funds rate. So you can see here that right now we are at 5.38, so in a range, the Fed sets policy in ranges. So we're right in the middle of the 5.25 to 5.5 range. That's 5.4. Or 5.38. You can see that we get at least the first cut and then some within 6 months. So we shed close to 40 basis points. So that's 125 basis point cut, and then about a 50% chance, give or take, for a further one within 6 months. Within a year, you can see we are down 1 full percent. In other words, what the markets are saying here is that come end of October, beginning of December 2024, rates are going to be a full percentage point lower. Within 2 years' time, they're going to be 2 percentage points lower. So at this point, we're down to 3.5. So 10 basis points here, 10 basis points there does not really alter the baseline, but clearly we've moved significantly lower, especially if we look at what the curve looks like 3 months out and further. So the markets have clearly moved since that November FOMC meeting to say, we're going to get easing, it's going to come sooner, and there's going to be more of it. The response from markets has been, as you might expect. So this is a chart that we go back to often. It shows you what happened with rate cut odds from mid-year through about October, and then from the end of October onward. And what has been the catalyst for this surge in stocks that we've just witnessed. And indeed, this relief of financial stress that we find right here. So you can see here that from about mid-year, the amount of rate cuts expected next year, which is essentially what this is saying, this is what's going to be the difference between rates in December of this year and December of next year, which effectively is just a measure of how many rate cuts are you going to get next year, since rates are now at standstill, according to the market expectation, of course. So looking at this now, this is the stock of rate cuts that the markets have envisioned for next year. And at mid-year, it's quite a lot. And the reason for it, of course, is because at mid-year, we're still smarting from the SVB-led banking crisis, as well as the latest version of a possible U.S. Fiscal cliff of some sort. Because, again, we're arguing about the debt ceiling at that point. As those things get put to bed by mid-year, you can see rate cut odds start to diminish. And what that's telling you is credit is going to be more expensive than people thought. Very tellingly here, this is that September 20th FOMC. You can see in the wake of it, uncertainty jumps in the bond market. We just saw that right here. This is that rise right there. And if we get back to here, the response, weaker stocks. And then we can see that those rate cut odds reach a turning point. So here you can see fewer rate cuts are expected for next year until the end of October, where once again we are starting to build out more of them. That's that dovish shift in Fed policy expectations we just saw. The response, a blistering stocks rally. Until that is, we get right here. And this is that standstill we've been talking about. This is essentially the flatlining that we have seen since basically the markets went off on the Thanksgiving holiday last week. Now, the very same thing is easily observed in the US dollar. So again, fewer rate cuts means more of a yield advantage to owning dollars, so a higher yield return on owning dollars because yields are expected to hold up more because fewer cuts are seen. So the dollar goes up. Once we turn over and start moving in the direction of more cuts, the dollar falls. The difference here is that while stocks have started to idle here, The dollar is still going. And that is very much the story if we look elsewhere in markets. Consider again this image right here. Yields are plunging. And so naturally the question is, well, what's going on with stocks here? If yields are going down this sharply, if the dollar is going down this sharply, but stocks are stuck right here, what is going to wake them up? They clearly have liked all of this before. What is it that they don't like now? And so with that in mind, we look at what the moving variable here is likely to be. This is, of course, the baseline Fed outlook as it stands currently. We have here the first cut already fully baked in for May, right here. So we can see here one full cut. This is the number of cuts or hikes. -1 is a cut. Easy enough. And one of them is fully baked in at this point by May. The likelihood of one earlier in March is at this point a non-negligible 46%, which means that at this point we have already a close to even chance that the cut comes even sooner. If that goes meaningfully above 50, it'll look like the Fed's going to go sooner yet. But at this point, May is fully on the table. You get a second cut with a 52% chance for a third in July, a third one by September, a fourth one by November, and this is really key here, 4 full cuts, so that 1% in easing that we just saw on the yield curve that we were just looking at moments ago. So here's where we are now. Here's where we're going to be a year from now. Notice it's almost exactly 1%. With a 2 basis point difference, or a 2% or a 0.02 percentage point difference. So when you look at this here now, 4 cuts or 1 full percent is already in the outlook, and a better than even 64% chance that there is a fifth. That is 1.25% or 125 basis points in easing next year. So clearly the market is very much looking ahead to this easing and expecting for there to be quite a bit of it at this point. And yet again, stocks are asleep, even as everything else keeps moving. So what can activate this? Well, one possibility, of course, is the U.S. PCE inflation data. And here, there is some cause for optimism. So the expectation is that we are going to get further disinflation, that we're going to come down to 3% on the headline here, and perhaps even more importantly, that the core reading, the one that excludes food and energy, which the Fed has very little agency over, that's going to continue to go down and will hit 3.5%. All of which would be music to the Fed's ears and encouraging of this lower yields, lower dollar, risk-on narrative. If we look at the makeup of what's in that service sector, which is clearly the main catalyst for inflation at this point, we can see that the green area, goods, has been squeezed to essentially zero. The average this year has been 0.6%. The average in the third quarter has been 0.2%. So we can clearly see goods inflation getting baked out of the cake at this point. It's services that matter. And when we look at services, the largest component still in play, not surprisingly, housing. Housing is still the biggest contributor because, of course, housing is frozen and prices can't come down fast enough because of the Fed's own actions. What the Fed has done with this aggressive rate hike cycle, in addition to conquering goods-based inflation, which is, of course, exactly the intention, what it's also done is locked up the housing market, because the mortgage rates now available for new borrowers are somewhere around 8%, whereas the average rate on already outstanding mortgage loans is below 4%. So in other words, if one wanted to sell their house and then buy another, they would have to finance the next one at double the interest cost, give or take. Needless to say, that has discouraged most people from selling homes, even if they perhaps wanted to, and to optimize for staying where they are as much as possible. No sellers, no price decline. And so this has been a sticky part of this entire inflation story. Now, we get some helpful guidance on this from the CPI report for the same month, which has already come out. Here, we saw inflation was a little bit better than expected. The expectation actually was that the core was going to hold unchanged, but that the headline would come down. So you can see here the core ultimately went down a little bit, expected at 4.1, which would have matched the prior month, but down to 4, actually. And the headline came down a bit. Now, for the headline, the influence is basically a write-off. It was very much expected that a pullback in oil would be a pull down on the energy price component of CPI, and that would give us a decline in headline. And indeed, we can see that here. So the yellow bars on the bottom there that are the energy contribution to CPI, you can see they were getting less negative, and so headline inflation was going up. And then it became more negative as crude oil prices fell back down. So oil rising, oil falling. So at this stage, that part of it was expected. The helpful part, the part that the Fed should be happy about, and ostensibly that the markets have been happy about, is what happened with the core. It came down, you can see here 0.1%, and that come down came because of services, which is exactly what is being asked for here. That's the part where inflation is still stuck. Now, if we go and break down what took down services, it was shelter. Shelter was the biggest downside contributor to services inflation coming down in this past month. And so what we find then is the very part of PCE where inflation is stickiest, housing and utilities, is the area where the CPI data would suggest there is room to come down, which is, of course, welcome news. And seems to suggest that we are going to get some PCE data that helps the lower yields, dovish Fed story. Now, looking at the way U.S. economic data on the inflation side of things has performed relative to expectations, there's a bit of a worry because we can see since about mid-year, inflation data has started to improve a bit relative to forecasts and is now a touch above 0 on this surprise index, which basically means that what we're looking at is inflation stopping to surprise lower. However, this is less worrying than it seems. There are two factors at work here. There's the expectations of inflation and the actual outcomes. And I think we saw in spades from the last CPI number, the actual outcome need not deviate dramatically for the markets to basically conclude, well, here's a piece of event risk that's out of the way now, and we can proceed with our dovish Fed story that we're so inclined to push forward. The upswing in this index seems to have more to do with inflation expectations coming down than it does with inflation data going up. And you can see that here. These are market-based measures of inflation. You can see from March, they peak and have since come down. The yellow there is the 2-year U.S. Treasury break-even rate. That's the inflation expectation from the bond market, implied by taking the difference between nominal and inflation-adjusted bond yields. So you get that inflation adjustment as the residual. The orange line is the inflation expectation implied in U.S. dollar inflation swaps. So just a different view of this. You can see the trend is very much the same. It's just periodic level changes here or there. But you can see that the turn in inflation expectations really starts at the beginning of March, and they come down. Well, the bottoming here seems to start in March as well. By July, the bottom is actually reached. So it looks like inflation expectations coming down is making it easier for the data to perform better relative to those updated expectations. But that doesn't mean that inflation is doing any better or going any higher necessarily. And of course, that's what we're looking to see, for PCE to tick lower. As long as that happens, it may be that the markets are revived because a piece of event risk has passed. The green light has ostensibly been activated, and the markets can have a bit more conviction. Now, we also have a bit more U.S. economic data on Friday. There's the ISM release, and Fed Chair Jerome Powell is going to speak. So maybe we don't get conviction just yet. But if, in fact, we are going to get favorable PCE data, and this snooze fest, for lack of a better term, on Wall Street continues, and then that doesn't really get relief once those ISM numbers and the Powell speech come out, assuming, of course, they don't rock the boat in any kind of a dramatic way, which, of course, is inherently unlikely. Well, then you might have a situation where something starts to look amiss. But in the meantime, perhaps this is but a pause, and perhaps the markets are just looking for event risk to get out of their way so they can proceed as they wish to. And if that's the case, and if the PCE number is going to comply as it seems is likely, well, then maybe we're looking at another surge in stocks here before the end of the week, and another big leg lower for the dollar, big leg lower for yields, nice upswing for bonds, nice upswing for the Japanese yen, and probably the gold prices as well. And that is Macro Money for today. Thanks very much for joining. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we try to figure out what happened on Wall Street that day and what it means going forward. I'm back on with Chris for Futures Power Hour on Sundays, on Fridays, rather. On Sundays, I'm on with Tom and Tony for First Call. And then I'm also writing for the News and Insights section of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks again for joining. Happy trading. See you tomorrow.